Alibaba is down 75% from its all-time high, and in this video, I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, Alibaba has grown revenue between 18 and 58% over the past 5 years. However, they saw a slowdown last year, but it seems that they are growing back again, as they reported 9% year-over-year growth on their last earnings, and analysts are expecting 7% revenue growth on average for the next years. Their net income and free cash flow took a hit in 2022, but they have recovered nicely since then. This is why analysts are expecting them to go from $2.80 per share to $9 in 2025. If analysts are correct and you assign a 15p to the company, it would make it a $148 stock, meaning 90% upside potential. The current PE is 11 and the forward PE is 9, which, in my opinion, is very cheap for a company like this. So far, the financials look good, as they are growing revenue, net income, and free cash flow. Now the question becomes, can we pay a reasonable price in order to make a good return on our money? In order to answer this question, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. Right now, you are seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. They mean 2 things. First, that in order to make the desired annual return that I have put in, which is 15%, you need to pay these prices. Second, if the low assumptions occur, you are going to make a 20% annual return on your money. If the middle assumptions occur, 28%, and if the high assumptions occur, 39%, all based on free cash flow. And I think my middle assumptions are reasonable, as I have the company growing at 7% annually, which is what analysts are expecting, 18% profit margin and 20% free cash flow margin, which they have done consistently in the past. I also assigned a 19 PE and price to free cash flow to the company and left the share outstanding at 0%, even though they have been buying back shares, so I was even a bit conservative. The Excel spreadsheet does not address any value to the balance sheet, and this company has an amazing balance sheet with $79 billion in cash and $23 in debt. They are going to use this cash to benefit investors either by paying down debt, buying back shares, which, as we have seen, they have already been doing, or by issuing a dividend, which they have just announced last week. Moving on to the pros and cons, the main risk of investing in this company is that it is a Chinese company. They have been under regulatory scrutiny, which has led to fines, amongst other things. The risk of delisting is also there, so if you are not comfortable in investing in a Chinese company, I wouldn't recommend investing in Alibaba. On the other hand, this is a growing company as they are growing revenue, net income, and free cash flow. They also have a great balance sheet, and China is a fast-growing economy. In my opinion, the main pro of investing in this company is the valuation. We have seen this on the Excel spreadsheet, and they are selling for a forward PE of 9 and a price to free cash flow of 7.9. For these reasons, I just started a position, but do not buy just because I own the stock. This is not financial advice, and you should always do your own research. I hope you enjoyed the analysis. Let me know what you think about the company in the comments, and I'll see you on the next one.